Thank you so much for coming to check out another episode of the Stash Cast, where we have interesting conversations with interesting people. Focused on the world of commercial real estate and prop tech, the Stash Cast is brought to you by Needle. What if you could use data and analytics to predict transactions before they occur? You can with Needle. Come check it out at Needle, Nedl.us to learn more. All right, I have my friend and prospective client at times, Ryan Smyth, with us today. He's the Senior Director of Acquisitions for Stoneweg USA. Ryan, thank you so much for coming to spend some time with me today.
Yeah, man. Thanks for having me.
Yeah, I'm curious. Let's talk maybe a little bit about your background, but then I really want to hear about your take on today's market and how competitive it is. So
Sure.
I guess I know who you are. We've been talking for years, but maybe if you could give the audience a little bit about who you are and what you do, and we'll roll from there.
Sure. So I come from a small town in the hills of West Virginia. Made my way down here to Florida about 8 years ago. I've been in real estate about 17, 18 years now. And really, I'd say that my experience would be a mile wide and an inch deep, but it's probably not the most accurate way to put it. But I've been in really every aspect of real estate. So residential real estate is what I started out in. I've been in new home sales development. I've been in development in DC, entitlements, that sort of thing. I got my master's degree from the University of Maryland in College Park in real estate development. And so now I've been in acquisitions, multifamily acquisitions for about 8 years now. And it's really what I enjoy. Again, everybody's career path is different, and mine zigzagged about as many ways as it possibly could. But to end up here in Tampa doing multifamily acquisitions, I very much enjoy every bit of it. Maybe not so much the market right now, but again, to come from a little town in West Virginia down to Tampa and to be working in this industry and work with people like yourself, I love it. I love every bit of it.
You're too kind, but flattery will get you everywhere. So how about that? um, that's awesome. I For a while I was researching getting my master's in real estate development. I didn't actually end up taking the plunge because I'm not that great in school. But how was that program? I've always been, I don't know if envious is the right word, but I've always been interested in that kind of level of higher education because, like, I have a degree in psychology and I've just had to learn everything on my own. So, how was that master's program?
Higher education gets a bad rap today, and in some respects, that's accurate. But for me, it really was the gateway to get to be doing what I'm doing today. Again, I started out in residential brokerage. I was in new home sales and development in West Virginia. And uh, for me, it was like, I want to achieve more than this. I want to get out. And
Mhm.
again, not to make West Virginia sound like a bad place, but to do what we do, you really can't be in a small town of West Virginia.
Yeah.
And really, that was the path that I explored and I ultimately took was going to University of Maryland, getting my real estate development degree, having that credential. And it took a while from that point. I'm not going to lie. I graduated. I've been looking, and it took me really 12 to 18 months to get the break into the industry. And unfortunately, this is one of the realities of being from West Virginia. Is I would talk to recruiters and I would talk to people in the industry, and they would be like, "You're from West Virginia. You're in West Virginia. Good luck," that sort of thing. And I knew that it was just going to have to take a lot of patience, a lot of pavement pounding, submitting my resume to places, uh, being able to demonstrate that I know what I'm doing. I'm going to be an asset. And eventually I was able to land a job, my first job in Orlando with Ventura Realty out of Toronto. And I got to give a moment here to give props to the guy who hired me, Craig Marbach, who now works for Hill
Yeah.
Point Residential. He actually plucked me out of West Virginia. And he said, "You know what? I like you. I'm going to bring you down to Orlando. I'm going to give you a shot." And that really changed the trajectory of my life because he was willing to take a shot on me when nobody else would. And I've told him, and if he ever watches, I hope he knows that he was very instrumental in me being where I am today. And for that, I'm eternally grateful.
I like Craig. I've never had the opportunity to work with him, but I've always thought he was a quality guy. So it makes
Oh, great
sense
guy.
that
Yeah.
you guys clicked like that.
Yeah.
Yeah, you've worked for a number of quality firms. What has been your experience? Because in brokerage, they say it takes 2 years to get traction. Sounds like it took you a similar amount of time frame. I guess what has your experience been getting into the industry and then evolving through, because you've seen a number of different shops, 29th Street, Ventura, obviously, and now with Stoneweg. Maybe talk about that a little bit.
Yeah. Every shop is different, obviously. And with Ventura being in my first position as associate director of acquisitions, Craig, he threw me into the fire a little bit. He brought me down to Orlando. He said, all right, this is what our buy box is. He would travel down from Atlanta to get my feet wet and introduce me to the brokers. But I moved to Orlando. I didn't know a single person. It was quite the change because a lot of my family is still in Morgantown, and where I'm from in West Virginia, and still in the Northeast. And I was basically saying goodbye to everybody. And I'm doing this for my career. This is what I want to do. And again, Craig was instrumental in all of that taking place. And for me, it was just a matter of, at that time, I was covering all of Florida, and I would just go look at every single deal.
Mm-hmm.
Every single deal that fit our buy box, I was going to look at it. So whether it was in Tampa, whether it was in Jacksonville, the Space Coast, I was looking at every single asset. I was getting in front of the brokers. I'm getting my face out there that they know who I am. And that was really how I got things started there. Doing market research, understanding what makes deals tick. And again, Craig was a great mentor in that respect and explaining the ins and outs of the industry. And obviously, buying deals a little bit harder today, but not as hard when I first got into the industry. It's really operating the deals that's very difficult. So getting
Right.
exposure to that happened when I went to 29th Street. So at 29th Street, it's a little bit different model than Ventura. Ventura is basically responsible for finding the deal, sending it up the chain, and then really they would make the decision up from Toronto. 29th Street, that kind of process was similar, but after the deal closed, I then ran the asset. So then I got at 29th Street, I got thrown into the fire on the asset management side. And
Right.
really, until you're in asset management, and at Stoneweg, we have a whole asset management team here, thank God,
Yeah.
because it's a whole other beast. And especially right now, you could buy a deal 2017, 18, 19, 20, interest rates would help you, the market would bail you out. And you saw a lot of that happen. Now, you really have to know what you're doing. You have to understand what makes a property tick. You can't underwrite 6% organic rent growth and expect to achieve it. You have to actually put in the work, and you got to understand what you're doing. You got to understand how much a renovation cost is going to be. You got to understand what makes a good property manager. And for me at 29th Street, I would be at the properties that we would buy, and I would be talking to the PM. I would go through the lead generation system to ensure that they're answering the phone, that they're replying all the emails, right into the nitty gritty. In fact, I would go so far as, one of the properties we bought here in Tampa, it was 88 vintage. Current ownership had sailed on the asset a little bit. And so when we bought it, I went in and all of the concrete walkways needed to be pressure washed. They're just thick with grime, all green, just terrible curb appeal. I actually went out myself with one of the rotating, and I don't know what they're called, but
Pressure
the
washers.
rotating
Yeah.
pressure
Yeah.
washer, yeah, with the spinning brush.
Yeah.
And I went out and pressure washed all the sidewalks myself.
I love it.
And
That's great.
and our property management company at the time would be like, I've never seen someone from ownership out here doing some of the handiwork. And I said, hey man, whatever, I'll do whatever needs to, whatever we need to do to get it done, because I know you guys are busy doing what you need to do. And this is something that needs to be addressed. So I'm not going to wait. I'll just come out and do, and I spent a couple of weeks doing that. But really, that was acquisition guys. And my asset management team tells me now, they're like, you're the best acquisition guy because you understand how a property works. You understand what we're looking at. When you underwrite an asset, you're not putting in these crazy assumptions that we have no way of reaching with a expense ratio of 25% and 200 a door and turn costs. You're not doing that because you understand that's impossible to achieve. And so we work very well together here at Stoneweg now that it's a collaborative effort. And I'm not in the asset management space now. I get to hand that off. But when I'm underwriting the deal, I get them involved early. I get to construction team involved early, and we all look at it. And I say, what's this going to cost? How can we operate this? Are there ways to trim the expense costs here? Can we achieve this organic rent? Can we achieve these rent premiums? You know, obviously, I have belief in what I've done, but I need their sign off. I want their sign off. I want them to say, yes, I like this. This makes sense. We can do this. And I'll push them a little bit because you have to be somewhat aggressive to get something done, especially in this market. But I also, as an acquisitions guy, I want to be a good steward of the capital, right? We're supposed to be buying assets to make money for our investors. And really, what you've seen that get lost a little bit over the last couple of years with some groups where maybe they've had a mandate, or maybe they just want to grow as fast as they can, or they're fee based, and they go out and they're not good stewards of capital. And for us, Stoneweg, we've been very selective with our buys over the last couple of years, and we didn't get over our skis in 21, 22. We bought, but fixed rate debt, long-term hold. And so now we can sit and digest this market the way it is and be ready to pivot when maybe there's a change in the marketplace, when there's more liquidity back in the market, and be ready to grow from there.
Yeah, I was laughing because what I know about you is that you can't, and not to say that we ever try to pull one over on somebody, but sometimes we might have aggressive underwriting, and I know that you're not going to buy off on that. I'm sure that when you were doing that power washing, that got back up the chain and was like, hey, Ryan's a real guy. He's going to make sure this thing happens. And that's awesome. I love that story. That's great. So I'm curious, you must see as many deals as I do, maybe even more, but your territory is much wider, focused in Cincinnati, Ohio, Kentucky, and Indiana is our territory generally. What are you seeing out there as far as deals? You mentioned a little bit about some of these groups that were, we'll say, acquiring deals, and maybe it was growth driven, grow at all costs. For last year and even into this year, there's maybe hope of this apocalypse of deals coming. Are you seeing anything like that?
I haven't seen a lot of that yet, but I will say that it seems like whenever the treasuries drop, like last week, you got like a 20 bip drop in the treasury, deals come out. And so last week, I probably got 10 deals within the markets I cover in a 4-hour span. I'd never seen that, but I can only attribute that to the fact that the treasuries had dropped. Brokers called their sellers that had been on the sidelines or been on the fence waiting and said, all right, let's go. The treasuries are down. Now's the time. If you want to take it out, this is probably a good time to do it. And you're probably seeing that as of last week. Overall, if you were at NMHC, the vibe out of that was nothing but positive. 3 rate cuts, 6 rate cuts. We're going to have back half of the year is going to be explosion of deal flow. And obviously that's not really has come true yet. Some markets are busier than others. My counterpart in Dallas, Garrett Pissark, he covers all of Texas, has been a lot more liquid than I'd say the rest of the markets we cover. I cover the Midwest through the Southeast, and I'd say probably out of all those markets, Atlanta has been the most liquid, but that's not saying all that much because a lot of the other markets have been very quiet. Charlotte, relatively quiet. Raleigh, very quiet. Tampa's a little bit more active. Orlando has actually been probably the most active outside of Atlanta. And then the Midwest has always been a little bit less liquid. Columbus, Cincinnati, Indianapolis. I cover Kansas City as well. You're seeing a little bit more deal flow in those areas, but no, it's obviously not anything like you saw in the run-up in post-COVID. But I do think that more liquidity obviously would be a great thing for a lot of buyers in the market. I think that the more you see come out, the more capital gets deployed. I actually think you see a little bit of cap rate alleviation because there is a disequilibrium in the market. You have so few deals that have been out this year that whenever you get a deal on a main, so say like in a Nashville or Charlotte, that deal is going sub 5 cap. If it's a location, it's a core plus or
even
core
still
asset.
even still
Yes,
today.
you're seeing that get bid up. And really what you're seeing on all of these deals, you get the same 5 or 10 groups that have discretionary capital ready to go. They want to get it out. They like the basis story. They think that rates will come down, or maybe they're doing a longer term hold. And so they can weather the whatever storm may happen over the next year, couple of years, and come out on the other side with strong organic rent growth. Because if you take a look at the construction pipeline and really all of these cities, starting at the end of this year into 2026, it really starts to go down because it's almost impossible to get a development deal financed right now. So you're going to see demand continue to be strong in all of these major markets, but the construction pipeline is going to wean, and you're going to see organic rent growth return. And I think you are starting to see that some places. Obviously, the Midwest, I think you're seeing more bullish projections than the Southeast right now. But that's not to say in the Southeast over the next couple of years you start to see 3-4% again as that construction pipeline gets absorbed. So you see groups, I think, again, underwriting outsized rent growth. But again, it's really discretionary money that's at the table. If you're equity, if you have to go out and source equity, I think it's, a lot of the institutions are still hesitant to put out capital. And I can't say that I would fault them. And you could point at obviously certain things in the economy and say, this is why we believe the economy is continuing to go up, or this is why we believe the economy is on the edge of a cliff. Mm-hmm. And we, again, going back to NMHC, we all try to predict that there's going to be all these rate cuts coming. And obviously here we are in May, almost into June.
Almost June, yeah.
Yeah. And the first rate cut at the latest was supposed to be June. And now it's probably September, or maybe it's after the election, because you got to factor the election into that. And that's a whole nother story. Inflation's still floating around 3.5%. That last mile that they have to do, the Fed has to do, doesn't sound like they have a lot of confidence to be able to get that done in a short amount of time. But again, who knows? If we are on the edge of a cliff, maybe we go off the cliff and you start to see unemployment tick up, and that justifies a rate cut. And Ash, I'm sure you look like at this point, the stock market, obviously hit an all-time high of 40,000. I think it's mostly decoupled from the overall economy at this point.
It's not real.
It's not an indication as to where we are as a whole, as a country.
It's probably a result of all the liquidity that was pumped into the market, to the economy during COVID. It has to find a home somewhere, and real estate prices arguably could be a result of that as well.
Oh, yeah, no doubt. Depending on your stance on COVID policy, and I don't want to go down that road, but
sure,
you saw money printed by the previous administration, which obviously had to be done in response to our response to COVID. When you shut down the country and you tell people to stay home and not go to work, you have to do something to keep the economy going. Obviously, we injected that money into the economy then. And that really should have been it. We had another bill after that, and then the current administration brought another bill after that. And I tell people, and people may not remember this, but Joe Manchin, the senator from West Virginia, my home state, was the deciding vote on the Build Back Better Act, which basically would have added not $2 trillion, but another $3.4 trillion on top of the $2 trillion. And so I think about the fact that maybe you would have had another $5+ trillion printed, and where we would be today on that. And yeah, if you ask my opinion on that, I think our monetary policy over the last 4 years has been very poor. I think Jerome Powell waited far too long to start raising the interest rates, and that's hurt. I don't have a lot of confidence in them thinking they have inflation under control. I think they're obviously trying to achieve the soft landing. I'm not fully convinced that we're going to get there. But again, I'm just one guy, but I just see, on the way in here today, we're talking about the spending that continues to go on. And I look at it, and I'm in this stuff every day because I want to see how the consumer can withhold and how long they can withstand what's going on with inflation. Can they continue to pay the rents that they're paying? Can we underwrite organic rent growth at 3 to 4%? And is that going to be achievable, or is the consumer as a whole going to start to really run out of gas? And that obviously has an impact on multifamily as an entire asset class. So I continue to try to watch for that sentiment and see how's the spending. what's the credit card debt like, where are the auto delinquencies at, and things of that nature, because should give you a little bit of insight as to where the consumer is. And there's a lot of things to point to that they could be running out of gas. And
Yeah.
really, yeah.
I had a meeting last week with a large owner, and they love massive deals, like 800 unit deal. 500 is a small deal for them. And what they said was there's two things. One, I'll back up a little bit with COVID. What was interesting, everybody thought that was the end of the world and we were going to see this avalanche of deals. But in fact, what happened was you saw a dip immediately because there's fear and paralysis. And then with all the money being pumped in, rents went up significantly. Did you
Oh,
guys
yeah.
see that as well?
Oh, yeah. So it's funny. We at 29th Street Capital, I was with them at the time when COVID struck, and we had two deals under contract at that point that actually closed in the second week of March. And so
Much.
we're going trying to get these deals closed because we weren't sure, how the financial markets were going to react to a slowdown. We had confidence that these deals were going to be good deals for us, so we wanted to get them closed and deal with any COVID repercussions later. But we saw it was wild here because they were both in Tampa. We didn't really experience any kind of slowdown. Maybe that first couple of weeks, but people were still looking online. They were still applying. They were still moving in. And obviously, as the economy started to open up, things just went bananas at all our properties. We have a deal here in Bradenton in Florida that we bought shortly post, whatever you want to call post-COVID, in May of 2021. And when we bought that asset, our in-place rents were around $1,550, and now they're $2,100. And that's purely mark to market. It's just we didn't do anything as a brand new asset. We just rode the inflation wave.
Yeah.
And yeah, obviously, especially down here in Florida, the unfortunate thing is a lot of that value that you create by raising those rent or having those rents go up has been offset by inflation offset by insurance, because insurance costs obviously down here have gone through the roof over the last 3 years as well. And what people don't understand, if you're not from Florida, everybody wants to blame climate change or hurricanes for the spike in insurance, but really what it was fraud. Fraud was really rampant in the state of Florida, insurance fraud. And there was a mandate where basically the insurance companies, if they were fraudulently taken advantage of or sued and they knew it, they couldn't recoup the cost if they took it to court. And so they still had to pay their own insurance or their own legal costs, even if they won. But it made sense for them just to say, all right, we'll pay it and move on because we're going to incur all these legal costs anyways. And Governor Ron DeSantis actually closed that loophole last summer. And so and what I was told was you had 80% of the fraud being done by two law firms out of Southeast Florida. Jeez. Those law firms are now no longer in existence, but they really made a living off of that. And then when the hurricane hit, that was the last straw, kind of what pushed everything over the edge. And really, that's when you saw the insurance costs just really go through the roof. And the hurricane was the catalyst of that.
That is crazy. So there are two firms that just said, hey, we see this loophole and we're going to take advantage of it. And it's legal until it's not.
Exactly. And so that's really, again, that was a years long problem. And then the hurricane was what really sent everybody over the edge.
Because then there are a bunch of real claims.
Yeah, then you have a bunch of real claims as well. And so that's what you're seeing now. The market down here has stabilized. We just went through our insurance renewal. We're paying the same amount, but for better coverage. And other groups I've talked to, they've seen a slight reduction in cost. And obviously, the longer we go, none of that loophole is closed. The longer we go without any kind of major hurricanes or major weather events, I think you see the market continue to soften a little bit. Carriers will come back in and you'll see pricing ease a little bit.
Are you guys big enough to self-insure? Have you explored that?
We have a master policy across our entire portfolio, but unfortunately for us, we've had a couple properties where we've had some crime that resulted in a lot of $1 million in claims that unfortunately we've had to pay out of pocket. And so for us, going back to Stoneweg, we pivoted about 2 years ago to a very ESG green platform, sustainability platform. And for us, it was really about getting out of that 1970s, 1980s vintage space and moving into newer product. And by doing so, we've gotten rid of some of the assets that really have been a drag on our policy, and we've seen our coverage get better as we've cycled out of those assets.
Yeah. Your comment about the asset in Bradenton is similar to what I was going to bring up, is with the rent increases like that are just riding the wave. Some of the tenants that are even living in the units are no longer income qualified because they've been priced out. And that's just a factor of COVID. Have you guys seen similar things?
We've seen that, but the back door is not open for long. If they leave, we see someone come in almost immediately and take their place. Occupancy at this property has been above 90%, oftentimes at 95% the entire time we've owned it. Because again, the net migration to Florida continues to be so great. I meet people from all over the country every day down here that just moved here. Obviously, no state income tax, the weather, the job market continues to grow down here. And so you just continue to see people move to the area. Obviously, that's a great thing for real estate. Bad thing if you're me and trying to because I live in Tampa and I drive across the bay to get to my office here in St. Pete. And I used to be able to get across the bay in a half hour. Now it's about 50 minutes to an hour because the traffic has continued to get worse. But it all comes with the territory because, again, I want to be in a place that is growing. I want to own assets in an area that continues to grow. And so Florida continues to make all the sense in the world for investment because you just continue to see net migration to the state.
That's a good point you bring up. I'm curious, you cover a wide territory. What do you see as the differences between like the Midwestern markets and Southeastern, and then even Florida might even be its own bucket in and of itself? Is it jobs? Is it employment? Is it incomes? I'm curious to hear from your perspective.
Yeah, any of all the cities I cover and all the markets I cover, they all are really low regulation, pro growth cities. We tend to stay away from cities and states that are highly regulated, poor weather, things of that nature that they're going to be a drag on growth. I always like to joke. I grew up an hour south of Pittsburgh, Pennsylvania. Pittsburgh, gorgeous city. Beautiful city. You've never been there. It's amazing. You got the three rivers. You got the bridges. It's a gorgeous city. But the weather's terrible. And if you took that city and moved it to the south, it'd be the most popular city in the United States, in my opinion, because it's gorgeous. But the weather is awful. And so it's hard to want to invest in places like that where you're fighting something that you can't beat. You can't beat Mother Nature. So that would be one reason we would never invest in Pittsburgh. City of Chicago, obviously very highly regulated. We're not from there. We don't understand it. It's too much for us to try to go in there. It would just be too much risk for us involved to try to go into a market like Chicago and be able to be competitive because I think if you grow up in Chicago and you understand Chicago, you can make sense of the regulation. You understand how it works. We don't have anyone from that area that we could go in there and say, hey, this makes sense for us and this is why. So we try to stick to markets that we understand, that we know the growth is there. And really the differences between the Midwest and the Southeast is just the Midwest is less of a rubber band, right? You just have more consistency in those markets. You're never going to see a big boom, but you're never going to see a big drop off either. They continue to be like the steady Eddie markets. You can count on continuing, growth in those markets. Obviously, you take Columbus, for example, the Intel plant that they're building there. That's a massive boom for that market. And people because you see this across the United States, right? More people moving from rural areas into the suburbs, into the cities. And that's the case in every market we cover, right? And again, the only difference between the Midwest and the Southeast that I see is just you get a little bit more of a boom and bust to some of those cities. Obviously, the supply pipeline being a big factor in cities like a Memphis or Charlotte or Raleigh, where you just have so much supply coming in right now that you really can't underwrite a lot of rent growth. And if you have a value add asset and you're underwriting $300 rent premiums, you're probably not going to get that unless you're unless you found a unicorn. The only difference between the Southeast really and Florida is, again, insurance. Insurance is a lot more volatile. You got to really pay attention to where the asset's located. If you're in a Cat 1, Tier 1 wind zone, you got to know that. You got to know if you're in a flood zone, flood AE zone. Those have a massive impact on insurance. Now, obviously, up in the Midwest, you're really okay no matter where you are. You don't have to really factor in being wind zone, being flood zone. Obviously, you have convection storms in the Midwest, but Columbus, Cincinnati, Indy, and Kansas City, the markets I cover, you don't really see that as much.
Yeah, that's true. I'm curious, from your perspective, is the market overbrokered? Are there too many brokers out there?
No, I wouldn't say so. Obviously, every market is different as far as to which broker shop is the top
dominant
dog,
player
right?
in each market.
Yeah, dominant player. Yeah. But I never have to think about, man, I haven't reached out to this group for a while, or I don't really know these guys. Like, I really, if you're doing transactions, I know who you are as far as all the markets that I'm in. I know who you are. Excuse me. I know who you are. I've offered on your assets. If you have assets out there that fit our buy box, I don't have to worry about who you are or where you come from. I was talking about this with a colleague last week. Brokerage, and I've done brokerage. It's so damn hard, and it's hard, and you got to grind for years and years to get to the top. And there can't be too many brokers because there's just not a lot of guys out there that can grind like some of you guys do. It's just an extremely tough business. That's why when we sell assets, the commission, totally justified. I know what you guys are doing. I've been on that side. And candidly, I wouldn't want to do it as a career. I like being on the phone, but I like being on the phone with you guys and talking to you about deals and talking to equity and things of that nature. I'm not the biggest fan of cold calling, and that's why I didn't last very long in brokerage. And so, no, I don't think it's overbrokered at all. The guys that do deals, they're out there doing deals. If you're not doing deals, you're not making money, and eventually you probably end up segueing into something else.
Yeah,
and
that's
at the end of the day, I think there's only so many mouths to feed, and the market kind of dictates that one way or another. When it's a slower market like right now, obviously there's some guys out there that are probably not doing as well as others.
Yeah, you're starting to see some transition over to your side of things, becoming acquisitions guys.
I don't know if that's the best thing to be doing at the moment. We don't need more acquisitions guys. Let me put it that way.
That's how I feel about brokers. We don't need any more.
Yeah.
In fact, go away. It's a terrible job. You don't want to do it. So what do, in your opinion, you talk to a lot of brokers, and what do the good ones do? And then what makes a bad broker? So what makes a good broker and what makes a bad broker?
That's a great question. For me, I try to be a good acquisitions guy, right? So when I look at something...
And I think you are, by the way.
I appreciate that because I'm going to underwrite the deal. I'm going to tell you why it works or why it doesn't work. And I'm going to give you specific reasons why it doesn't work or why I do like it. I got to look out for our investors. I got to look at what our returns are. And I got to point as to why I can't do the deal or why I may be able to do the deal, why I could push here or why I don't think I can push there. And I want to give constructive feedback to the brokers. And so that's what I try to do on my side. When it comes to being a good broker, really it's being on the phone. Some brokers will call me just to say, hey, what are you up to? What are you guys looking at? I have brokers.
Are those constructive? Are those constructive? Because like when I'm on the phone, I'm a mercenary. I'm like, do you want to buy this deal or not? Because if not, I got to find somebody who is. But
I find it constructive because anytime I'm on the phone with a broker, that's a good use of my time.
Mm-hmm.
Right. I want to be talking to them. I want to see what they're seeing. A lot of them pick my brain on what I'm seeing. And it just helps further that relationship, that collaboration. There's nothing bad about it. There's nothing negative about me being on the phone with brokers. And again, some will reach out and just see what we're looking at or how we're doing. And then other times, brokers call if they think of me when they have something that maybe, Stash, you also do this, will bring something to me off market or something that may or may not be a fit. And I'm quick to, again, in that regards too, I'm quick to respond and this may or may not be a fit. This is why. Um, and for me, it's just the good brokers are just as uh, collaborative with feedback as I am. I'll have brokers call me and say, all right, this is best and final. This is where cutoff is. These are the groups, not naming them obviously, but hey, we got a discretionary fund, we have a family office, that sort of thing. And they give me a lay of the land and they tell me where they think it's going to go. And that's the stuff that I need to go back to my investment committee and say, all right, we lost this deal. Here are the players. Here's where the money is. Here's where the cap rate is probably going to be. And so that allows me to paint the picture for the market to my investment committee. What makes a bad broker? I can't really say that I have poor experiences with brokers. Every deal that I've done, they more or less have been there guiding the process, understanding the nuances involved. Obviously, on the sell side, uh, I like to, when we get BOVs, I like to pick the BOV that I think is most realistic because I'm going to underwrite the asset myself where we would buy it to where I expect the market to be. And if I get a BOV that's several tens of thousands of dollars a door higher than that, I know they're just trying to win the business. For me, that always gives me kind of the ick, right? Is that you're not being truthful with me. You're just trying to win the business and figure it out later. Buy a listing, yes. And if there's one thing that brokers talk to me about that frustrates them the most is them losing a listing to another group that bought the listing.
Yes.
And I totally, again, having been on the brokerage, I totally understand that. And I tell the brokers when we go out for BOVs, look, this is what we think. Send me a BOV, and I'm going to know who's pegging it to where they think they can get the price, and others where they think we want to see the price. Mm-hmm. Now, obviously, I want to get the most money for the deals that we sell, but I also, again, I don't want to do the whole song and dance where they hit a strike price so high and everything comes in much below that, and then we're sitting there going, all right, now what do we do? And we've also gone through that process in the past, as every seller has, but I don't. Again, having interacted with many different brokers, I don't find any of the guys and ladies that I talk to not be good at your job. Because again, if you're selling $80 million deals, you have put in the time, you understand the markets, you understand the business, you've done the grind to get where you are. It's not like you just dropped out of the sky and started getting $80 million deal.
It's highly unlikely that happens.
You've been on the grind for years and years. And so you understand what it takes because you're there to get to that level. And so I can't say that I interact with bad brokers.
Mm-hmm. Yeah, you're probably above that level, candidly. Yeah. I've been doing it for 13 years now here in Cincinnati, and I only just recently feel like I'm hitting my stride. I'm getting, you might say, the respect that I feel like I probably didn't deserve when I first started, but I thought I did. But I finally feel like I'm hitting a stride, which is cool. It's nice. So you mentioned earlier that Stoneweg a few years ago made a conscious decision to really focus on the ESG. Can you talk about that a little bit more? And then I'm curious, as a follow-up, like what technologies have you used or implemented to help facilitate that strategy?
Sure. So the ESG platform is a ongoing evolution of what we've been doing over the last couple of years. And really, a lot of the focus is on the E part of it, right? The environmental part of it. And again, this is from us wanting to be good stewards of capital and do things that positively impact the environment. And really, there's a lot of legwork that has to be done. It's not just something that you just say, all right, we want to do ESG, and this is what we're going to do. And obviously, there's instances of greenwashing. I don't know if you've heard of that, but where companies say they're doing green initiatives, but they're really not. They're just
how do you get away with that?
That's a good question. I guess you could claim to be environmentally conscious, but not really actually.
Or if you have a lender inspection and you said, yeah, we installed all new low flow toilet heads or toilets and shower heads, you only take them to a sample, that the ones that you actually
things
did.
Like that. Yeah. Because here's the rub on the ESG implementation. It's tough to do these initiatives and make money, right? Because at the end of the day, we're all in it to make money. And we have a director of sustainability, Tom, who basically leads up all our ESG initiatives. And his responsibility is to determine how much a project is going to cost, what kind of tax credits can we get, what's the ROI going to be on this investment. And that's been the biggest hurdle. For example, to do a solar panel installation, maybe it costs 50 grand to do so. You take your clubhouse off the grid, but you're only saving yourself maybe $600, $700 a month. And so if you look at the span of time it takes to actually recoup that 50 grand, you're talking 4.5 years. And so if you're doing a 5-year hold, does it make sense to install solar panels when you really don't start making money on it until the 4th year of ownership? Mm-hmm. And so that's one thing that we continue to work through, because at the end of the day, again, it's all about the profit, and we want to do well by the environment. And so for us, it's continuing to do discovery as to what may work. One thing that works really well is smart home tech. Now, there's a difference of opinion on whether or not smart home tech can be considered ESG, but it does monitor the output of flows, as far as power, water pressure, things of that nature, and can help us keep our utility costs down. But other things that we do, EV charging stations, we do that. We do those at almost every single property that we buy. We put in EV charging stations. Obviously, all new LED lighting throughout the property is something that we do on every property that we purchase. Obviously, low VOC paint, things of that nature. Low VOC, obviously less harmful to the environment is the best way to put it. I couldn't tell you what VOC stands for off the top of my head. So
that's all right.
I know it's a less, it's more environmentally friendly. I'm going to put it that way.
Okay.
And again, that's something else that we do, but it's a continual research project for Tom, again, our director of sustainability, to find out the best practices when it comes to implementing sustainability and green initiatives. And that really comes, we're a European company, right? We're based out of Geneva, Switzerland. Again, it's a philosophy of our company to be green conscious and to really drill down on sustainability efforts.
Interesting. So you mentioned tax credits. Has the government incentivized the implementation of ESG solutions, and will they give you a discount on taxes?
Yes. And this is a little bit out of my purview, but I've looked at
keep it high
underwriting.
Level.
Okay. Yeah. We've looked at the underwriting, and yes, if you install a solar panel system, you will get a tax credit from the government. And so again, it's our sustainability, it's a team effort on their end to understand where the credits lie, how we can recoup those costs. Unfortunately, and this is a problem we run into, yes, we can underwrite receiving a tax credit, but does it impact the deal returns? No. And yes, we could do these initiatives, but we can't underwrite it at the deal level. So we can't show investors that we're going to recoup some of these tax investments, because it's something that it's an arbitrary number. I don't want to say arbitrary, but it's a number that we're not sure what the total tax credit is going to be. And so we can't obviously account for that cost. Now, it's something that, again, we continue to work through. And I'd really say that we're on the front edge of this kind of platform, this sustainability platform, because it requires a ton of man hours to really understand the nuances, to understand the nooks and crannies of where the benefit lies to do these projects. Because again, we've looked at it like, okay, we're going to do a project that saves someone $50 a month on their water bill or their electric bill. Okay, can we make more money? Can we charge more rent by doing that? Probably not. But at the end of the day, our expense costs would be lower. Maybe we see a little bit of value accretion at the exit. Mm-hmm. And so since we don't have any data that shows this having already gone full cycle, we continue to work with consultants, and Tom continues to work with his team to figure out how can we do this, make money, and be sustainable, and it all makes sense. And that's right now we're still morphing that and trying to understand how can we do all these initiatives and it make money and help the environment, and it jives with our ESG platform.
Well, ESG it's a big push. It's a big market, so I'm sure we'll all get it figured out here one of these days.
Yeah, again, our big focus is on the E. That's really social governance. That's self-explanatory, right? You want to do what's right by your residents. At the end of the day, you want to give them the experience that they expect. And we always try to achieve that. We're not perfect. No operator is, but we also we strive for max satisfaction out of our residents. And that covers most of the S. And then the governance, yes, we're gonna abide by governance. We're gonna use the government to achieve some of these initiatives. And so really the big factor and the big focus is on the E part and the sustainability part.
Mm-hmm. That's awesome. We're almost here at the top of the hour. Is there anything that you want to add, or any closing words of wisdom or advice that you have for us?
Oh, for whoever's watching, I assume you're probably in the real estate industry or real estate adjacent, and it's been tough, right? It's been tough for acquisition guys, for brokers, anyone that depends on deal flow to really make a living. And it's been 18 months now of being in this rut. And who knows when we're gonna get out of it. I would love to be able to have a crystal ball and be able to tell you exactly when things are gonna change for the better, but it's really a grind right now. We underwrite multiple deals every single week, and 99.9% of what we look at is not penciling. It doesn't make sense to us given our return parameters to do a deal. And I say it's better to do no deal than to do a bad deal. Because
Sure.
again, as I mentioned prior, we're supposed to be stewards of other people's money and other people's hard-earned money and their investments. And for me, I like to sleep at night with a clear conscience. And I'm never going to be someone that just goes out and says, "All right, we're gonna assume all of these high rent growth, low expenses. We're going to push this deal through because we got to get a deal done."
Yeah.
I don't prescribe by that, and that makes things tougher. And really for me, the words of wisdom would be that should be what we all strive to be like. Though again, we're all almost all of us are using other people's money to make a living on the buy side, right? When an acquisition guy goes out and gets the deal under contract, he's not buying with his own money; he's buying with investor money. And for me, it's just that's something that we should all remember because, again, at the end of the day, we're here to create value for our investors and to create value for our residents. And sometimes I think that gets lost. And obviously, I don't want to dive too much into that, but for me, again, it's just you want to be good stewards of other people's capital.
Yeah. No, that's a great philosophy. As we wrap up, if somebody, wants to get in touch with you, assuming they don't know you, what's the best way to reach out?
Yeah, I mean, you can
If they've got a fat, juicy $80 million deal for you.
well, call me on my cell phone. I've had the
Yeah.
same cell phone number since I was 15. It's
That's
like a
awesome.
it's like an appendage of me now. Like I can't get rid of it. It's 304-290-9802. You can email me. It's ryan.smyth@stoneweg.com. So that's Smith with a Y. So that's Smyth at Stoneweg. It looks like it's spelled or pronounced Stoneweg, and everybody calls it Stoneweg, and I don't correct anybody. But
Yeah.
it's STONEWEG.com. So
Awesome. One last question. When you're doing your BOV, or when you're doing your values, when you're underwriting deals for acquisition, have you found that the spread is like 20%? Because we found that the spread over the past 18 months is about 20%.
but the bid ask spread,
Yeah. If you're underwriting, okay, it makes sense here, but they want this number up here.
yeah, we've been consistently. I'd say it started out maybe like 15%, and now it's compressed a little bit. And now I'd say we're mostly 8 to 10% off. With the treasuries dropping, that's obviously it's helped us get a little closer to where maybe we're 5 or 6% off. And I'd say between that 5 and 10% is where we consistently, because we track every deal, every
Mm-hmm.
single deal that we underwrite across the nation. We track where we valued it, we track where it sells, and we have a nice little handy spreadsheet, color coordinated and everything that shows exactly how far we're off. And again, it's probably 5 to 10% consistently across the board. And obviously, I look at who buys what, and so I understand some of these buyers. I get what they're looking at. I get why they got to this price. And again, the big thing right now is buying on basis, and I think that makes a lot of sense in doing a longer term hold. And so we typically underwrite to 5 year, and that again it makes us a little bit less competitive in this current environment. But long term, we again, as I mentioned earlier, we didn't buy anything at the apex of the market. We don't have any floating rate debt assets that are really squeezing us, so we can sit and continue to be patient and wait for what I think will be good opportunities down the road.
I have one more question for you. So is this around brokerage? And I'm not sure if it happens or not, but so my job, as I see it, is to go out there and represent my clients and get the highest and best price and terms. But I sometimes feel that maybe the MO of some other folks out there is to almost underprice it and then push it up through best and final. So it's almost like you dog your own listing and then you push it up once you get bids in. Do you see that happening? Do you know what I'm
I've
saying?
seen that happen. Yeah, I've seen that happen a couple of times. From what I've been told, it was intentional. They it was a collaboration with the seller to price the asset a little bit below market and to get a frenzy
Mm-hmm.
and then bid it up. And so, yeah, I have seen that, but it was totally by design. Now, again, you have to go and sift through 60, 65 offers on one asset. But if you're willing to put in that legwork, you can get 5 or 6 groups that continue to run up the price. And yeah, so I've certainly seen that, but it wasn't by accident.
Hmm. So it's not necessarily widespread. It's maybe in certain instances. I just wonder if it
Yeah,
was.
so I've seen it once or twice.
You can't pull that trick every single deal because then people are going to
No,
catch on. Yeah.
no. When I saw it done, it was really perfect timing. It worked out for the seller. I can't knock it. Because I talked to many different other groups that looked at the deal, and everybody was like, "Oh my gosh, I got the guidance on this," and I was like, "Oh, this deal actually works." And then they found out that there's 65 offers on it, and back to the drawing board.
Oh, you
Yeah,
got me good.
yeah. Because
Yeah.
I'd say I don't know the exact makeup, but there's probably I'd say probably 80, 90% of shops out there are like ours where we're underwriting, we're looking, we're bidding, and we just continue to get beat and get beat. And you're looking for just some kind of diamond in the rough,
Mm-hmm.
needle in a haystack. And when you think you find one, you just get uber excited. Oh, this deal actually makes sense. And this was an instance where I think all of us got caught up in the excitement of finding a deal that underwrote, not realizing that it was intentionally priced that way to get us all into the mix.
Yeah, that's good. All right, Ryan, thank you so much, my friend. And it's been a pleasure. I really appreciate it. And I hope you have a great rest of your day.
Yeah, I had a great time, Stash. Appreciate the invite, and I'm sure I'll talk to you soon.
Absolutely. Thank you.
All right, see ya.
Bye.